The longest government shutdown in U.S. history just broke, and Wall Street insiders are about to make millions. In the next video, I'm going to show you exactly how to position your portfolio to capture this massive opportunity. Hey everyone, welcome back to StockScope Live. I'm your host, and today we're breaking down one of the most anticipated economic events of 2025, the official end of the record government shutdown and what it means for your investments. For over a month, federal agencies have been dark. Federal employees haven't received paychecks, and the FAA has been threatening flight restrictions over Thanksgiving. And worst of all, the Bureau of Labor Statistics hasn't released crucial economic data, leaving investors flying blind. But here's what just happened. On Sunday, November 9th, a bipartisan group of senators from the Democrats and the Republicans moved forward with a procedural vote. The bill clears the path for government reopening through January 30th, 2026. And for the first time in weeks, Wall Street is pricing in a real resolution. Betting markets are assigning about a 92% probability this ends by month end of November. And that's your signal to start looking at the market more carefully. First key point, let's start with what this shutdown has cost. First, there's the GDP growth. That's the Congressional Budget Office estimated that Q4 GDP will be reduced by up to 2%. That's massive. But there is a silver lining, that this is temporary damage. Once the shutdown ends, a recovery bounce is virtually guaranteed. We're talking pent-up spending that'll hit the economy hard in December and January. Number two, consumer confidence. While that hit a 3-year low in November because Americans are terrified, sentiment surveys are backward-looking. Once the shutdown ends and federal employees get paid, you'll see a dramatic swing in sentiment scores, and it'll trigger a relief rally in equities. Number three, job losses. Job cuts in October hit their highest monthly level since 2003 due to the shutdown. Once certainty returns, companies stop hiring freezes and start expanding again. Amazon and UPS layoffs were directly shutdown related. Once government reopens, you'll see hiring re-accelerate. Now here's what's crucial. Markets are forward-looking. You don't wait for the good data to hit. You front-run it. Airline stocks, American, United, Delta are already rallying because smart money knows the shutdown is ending. Institutional investors are positioning early, meaning retail traders who move now will catch the wave. Number two, the Federal Reserve hidden book. And they're sitting on a secret weapon, which is liquidity injection. Bob Savage, head of macro strategy at BNY Mellon, just revealed something crucial. The combination of government shutdown risk, massive treasury issuance, and decline in foreign interest in U.S. assets created a precautious liquidity environment. Translation, liquidity is super tight right now. And you can see it in the Fed overnight borrowing. But here's the plot twist. Once the shutdown ends, the Fed has signaled willingness to stabilize liquidity. That means potential money printing or quantitative easing signals coming in early December. And when the Fed is about to ease, there's only one place institutional money flows: equities. Specifically, quality growth stocks and AI-related names. Think about what happened in 2009 after the financial crisis. Once the Fed signaled monetary easing, the S&P rallied 65% in under a year. We could be setting up for something similar in a compressed form. Sectors to watch: technology and the Nasdaq, which was hit hardest by the shutdown uncertainty and is going to rebound the fastest. Financial services will benefit from renewed lending and deal making. Energy is going to benefit from geopolitical rebalancing and demand recovery. And healthcare, defensive play with earning tailwinds. So keep an eye on that. One thing to mention, that gold and silver have already made their move. Gold is already up to 4,100 and silver already made it to 50. Oil bounced back to around 60 from 58. So we're already seeing this in the market because, as I said, the market's price in future looking. So now let's talk about actionable trades, because there are three sectors set to explode once the announcement goes mainstream. Number one is semiconductors and AI infrastructure. NVIDIA, Broadcom, ASML have been under pressure during the shutdown due to broader tech sector pullbacks, as well as China export concerns. But once the government reopens and the Fed signals liquidity, institutional investors will return to highest growth names. UBS just raised their 2026 S&P 500 target to 7,500, implying a 3 to 5% upside, and that's driven by AI infrastructure spending. When money flows back into tech, it flows hardest into semiconductor plays. The NVIDIA crash was technical and shutdown driven, not fundamental. Accumulation in NVIDIA at sub 200 levels is a classic capitulation move. Number 2, the financial and regional banks. Banking sector stocks got hammered on shutdown fears. Companies couldn't access credit facilities, deal pipeline froze. Things like JP Morgan, Goldman Sachs, and regional banks will see immediate earnings reactions when credit markets normalize. Once the government reopens, we'll see deal-making resume, M&A pipelines activate, and net interest margin stabilization. Financial sector has 12-month upside to about 15 to 18%. Number 3 is airline and travel. This is the most obvious. American Airlines, United, and Delta are already rallying because airlines have pricing power in recovery environments. The FAA flight restriction will be lifted. Thanksgiving and Christmas travel bookings will surge. Plus, the travel sector hasn't participated in the 2025 rally. It's a value play with operating leverage to a reopening economy. Something that's critical, and you need to make sure you look at this, is you need to buy the dip before the announcement goes mainstream. This is not financial advice. By the time it's official, 60% of the move will already be priced in. Smart money moves 24 to 48 hours ahead of news. So if you're watching this video after the shutdown officially ends, these plays are partially played out. Last thing is what to avoid. This is very crucial. There are certain things you need to avoid during this recovery. Number 1, avoid growth at any price. Companies with no earnings but high beta will see mean revisions, meaning if they are based on feelings, you think quantum is going to be huge in 10 to 20 years, that's no revenue stream that you want to bet on. During uncertainty shutdowns, investors fled to mega cap safety. Once uncertainty clears, fund managers will take profits on overextended names and reallocate to value and lower beta defensive plays. Second, avoid emerging market exposure. For the next 6 weeks, dollar strength will persist as certainty returns to the US. EM currencies and stock underperform in risk-off environments, which is where we still are until the shutdown officially ends. You need to wait at least 2 to 3 weeks to add EM exposure. Number 3, avoid commodity-heavy portfolios. Oil, copper, and gold rallied on shutdown uncertainties and economic weakness fears. Once growth returns and risk appetite normalizes, commodities typically consolidate. Gold had a massive run, and it's been consolidating around 4,000, so it might be the odd one out. So pay attention. I'm going to give you 4 things to action. Number 1, make sure you prepare a list. Make sure that you get in a position early ahead of certainty. Make sure you set trailing stops, and make sure you subscribe to this channel and hit the like button on this video so you can catch all this information up front before it's too late. Look, the government shutdown has dominated the headlines for over a month, and it's making it harder and harder to create content or recommend new stocks. It's created uncertainty, fear, and indecision in markets. But uncertainty creates opportunity for informed investors. Smart money, it's already positioning. Better markets or betting markets are already pricing in resolutions. The question isn't whether the shutdown ends, it's whether you will be ready to capture the upside when it does. Markets have a saying, buy the dip, sell the rip. The dip was the last week of October and first week of November. The rip is about to start. I'm not here to guarantee you profits, but I am here to give you the information smart money is already using. What you do with it is up to you. If this video helped you understand the shutdown market's implications, make sure you like the video and comment what you think happens to your portfolio post-shutdown. And if you're ready to level up your investing game, make sure that you seek an investment professional. Thanks for watching, and I'll catch you in the next video.